Good morning, afternoon, or evening, depending on when you're watching this epic saga unfold. Welcome to Financial Institutions, the blockbusters of the Indian economy. I am your host Narayana, and today we are diving deep into the financial plumbing of India. Think of it as the Avengers of the economy, but instead of saving the world from Thanos, they are saving your money from, well, mostly from you spending it on all impulse buys. And yes, for more such thrilling financial adventures, do subscribe to our YouTube and Telegram channels because who doesn't love a good sequel or better yet, a whole cinematic universe of financial wisdom? Welcome, aspiring bureaucrats. Today, as we know, we'll be talking about the backbone of India's economy. Without these, the economy would be like a Rajinikanth movie just without punch dialogues. It's unthinkable, right? So grab your chai and get ready. Let's dive into the world of money movers. So today we'll be looking into introduction commercial banks, cooperative banks, RRBs, SFBs, DFIs, NPS and regulators. Like it might look long like a live, okay, but still we'll be looking in detail. Like think of it like a Rajinikanth blockbuster, big cast, powerful roles and a dramatic climax. That's what today's lecture is going to be. Financial institutions are the bedrock of the India's economy, facilitating flow of funds and enabling economic growth. They range from neighborhood banks to the specialized fintech companies, all playing a crucial role in nation's development. They channel funds, keep salaries flowing and support dreams from a farmer's tractor to your EMIs. They are the unsung heroes behind every financial success. Commercial banks are profit-making powerhouses. Okay, they that accept deposits and grant loans to the individuals. They are the core of the Indian financial systems. These banks are categorized into scheduled commercial banks and non-scheduled commercial banks, wherein the scheduled commercial banks are recognized under the RBI Act of 1934, gaining access to preferential rates in exchange for adhering to RBI rules like maintaining CRR and SLR. Within SEBs, we have the public sector banks, government majority owned banks. Example State Bank, Canada Bank, they are known for their strong sense of duty and recent finance health improvements. Moving on with the private sector banks, which are privately owned by individuals or entities. HDFC Bank, ICICI Bank are such examples and are characterized by agility, tech savviness, and aggressive digital expansion post 1991 liberalization. Foreign banks, branches of banks headquartered outside India. Citibank, HFC, HSBC, DBS Bank are examples, focusing on niche operations like trade finance, investment banking under both home country and RBI regulations. Moving on to the PYQ, which of these following is not included in the assets of a commercial bank in India? Take some time to understand the question and answer. Think of the answer. See, the correct answer is deposits. They are not included in the assets of a commercial bank in India because they are liabilities because representing money the bank owes to the customers. So deposits is the right answer. Moving on to the cooperative banks, like they are the community heroes and are operated by their members, providing credit and banking facilities primarily to small borrowers, small businesses, and often in rural and semi-urban areas. They operate on principles of cooperation and mutual aid. Their structure includes rural cooperatives and urban cooperatives owned by members. They serve farmers, small borrowers. Think of them as a local superheroes with a financial fist. That is cooperative banks. So rural cooperatives. Rural cooperatives have short-term credit structure for agriculture organized in three-tier system, starting from the state cooperative banks, which at the state level, district central cooperative banks at the district level, and primary agricultural credit societies at the grassroots. So each, the highest apex body deals with the lower body, district central cooperative banks, and the district central cooperative banks deals with the credit primary agricultural credit society. In all, they are more focused towards agricultural and also provide banking facilities to individuals and institutions as well. Moving on with the PYQ, consider the following statements. In terms of short-term credit delivery to the agriculture sector, district central cooperative banks, that is DCCBS, deliver more credit in comparison to scheduled commercial banks and regional rural banks. One of the most important functions of DCCBS is to provide funds to the primary agricultural credit societies. See, regarding the PYQ, statement 1, okay, DCCBS delivering more short-term credit to agricultural than scheduled commercial banks or regional rural banks is wrong. Okay, so scheduled, they lend more. However, one of the most important functions of DCCBS is to provide funds to the primary agriculture credit societies. This is right. So eventually option B is right. Next comes the urban cooperative banks, which are cooperative societies providing banking services to small borrowers, small businesses, self-employed persons, and salaried individuals in semi-urban areas. Okay. They are regulated both by RBI for banking functions and the Register of Cooperative Societies of the respective states for management and incorporation. Multi-state urban cooperative banks also involve the Central Register for Cooperative Societies as well. Now coming on to the prelims 2021 PYQ on urban cooperative bank. They are supervised and regulated by local bodies set up by the state governments. They can issue equity shares and preference shares. They were brought under the purview of the Banking Regulation Act 1949 through an amendment in 1966. Okay. See, we should know, we looked in the previous slide that the banks, urban cooperative banks, are regulated and supervised by RBI and Register of Cooperative Societies. So this option is wrong. So when these two options, statement 1 is wrong, eventually we are left with statement 2 and 3, which is correct. Moving on with the regional rural banks, established in 1975 under the RBI Act, are the hybrids combining the local cooperative field with the commercial or capital base of the commercial banks. They bridge the credit gap and promote financial inclusion in rural areas. The ownership is 50% of central government, state government 15%, and sponsor bank of 35%. Their main objective here is to provide credit and banking facilities for agriculture and other providing productive activities in rural area, particularly to small marginal farmers, agricultural laborers, artisans, and small entrepreneurs. They also disperse funds, wages, pensions, and offer para banking services. Let's look one PYQ on this. It was asked in direct credit assistance to rural households. See, NABARD, National Bank for Agriculture and Rural Development. It is particularly on refinancing. Okay, so here second one is wrong. So eliminating this use is left only with option C, which is the right option. Coming on with next, small finance banks introduced in 2014 are specialized banks for unserved and underserved sections like small business units, small and marginal farmers, micro and small industries, and the unorganized sector entities. They function like a full-fledged commercial banks but with specific conditions. That is, at least 50% of their loan portfolio must be loans up to 25 lakhs. Okay. and they have higher capital adequacy requirements, and 75% of their um, priority 75% priority sector lending mandate, they cannot set up subsidiaries or deal in financial products. We look about one more PYQ here on small finance banks in India. They supply credit to small business unit, they supply credit to small marginal farmers, they encourage young entrepreneurs to set up businesses, particularly in rural areas. See, they are only about supplying, not encouraging. Okay, so you have to note the word here, which makes it which brings in a doubt on this answer. So we can call it an extreme statement as well, extreme word as well. So eliminating option or the third statement from the options gives or leaves us with only one option, which is option 1 or option A 1 and 2 only. Coming on with the next is the payment banks, which is conceptualized by RBI in 2014, focusing on financial inclusion for migrant laborers, low income households, small businesses, and other unorganized sector entities. Okay, they can accept demand and deposits up to 2 lakh per customer, issue ATM debit cards, provide online banking, and distribute financial products as well, such as mutual funds, insurance. However, they cannot undertake lending activities or issue credit cards. This is very important, we should know that. They must also invest a significant portion of deposits in government securities. Okay, we'll look one PYQ on payment banks. Mobile phone, telephone companies and supermarket chains that are owned and controlled by residents are eligible for promoters of payment banks. Payment banks can issue both credit and debit cards. Payment banks cannot undertake lending activities. So we very well know that payment banks cannot issue credit cards. So which, by eliminating option 2, we are left with only one choice, that is option B, which is 1 and 3 only. Now moving on with the non-performing assets, like they are also called bad loans or loans where principal interest payments have been overdue for a period of 90 days. They significantly challenge the Indian banking system by impacting profitability, lending capacity, and overall financial stability. It brings in economic slowdown on sectoral, aggressive lending, and lax due diligence. Okay. Willful deposits by borrowers who can repay but choose not to. External factors like global shocks or commodity price volatility, frauds, practices like diversion of funds, inadequate monitoring by banks, and interest rate fluctuations will definitely affect it. Now, what are the consequences of the high NPAs? Reduced profitability of banks. Banks make provisions for bad loans, reducing the profits. Reduced lending capacity. Bank capital gets tied up, which limits the fresh credit. Higher cost of funds and increased lending rates. See, banks may raise rates to cover losses, which brings in higher interest rates when new loans are borrowed. Erosion of capital. Persistent NPAs can deplete capital, leading to insolvency or solvency crisis. Lack of public confidence in the banks decreases. Impact in credit rating. High NPAs can lead to downgrades, making borrowing harder. Hindrance to financial inclusion. Weak banks are less inclined to lend to priority sectors or small borrowers. NPA resolution mechanism. What is that? Okay. To combat NPAs, the government and RBI use several mechanisms like insolvency and bankruptcy code, a comprehensive law for the time-bound corporate insolvency resolution aiming to maximize asset value, balance credits, where creditors can initiate a corporate insolvency resolution process before the NCLT, National Tribunal. Asset reconstruction companies, financial institutions here um, acquire NPAs from from banks at a discount rates, okay, discounted price, and to recover dues, helping banks clean their balance sheets. That is something which it does. Next comes the SURFACE Act, empowers bank to recover this uh, secured loans dues directly without court intervention by taking possession and selling off the secured assets. That is through SURFACE Acts of 2002. Prompt corrective action framework. See, RBI supervisory framework for stressed banks, which imposed restrictions to prevent further deterioration and restore the financial soundness of the bank. Export Credit Guarantee Corporation. It is a limited government-owned company under the Ministry of Commerce and Industry. Its purpose is to promote exports by providing credit insurance, support to Indian exporters and bank, and covers commercial risks and potential political risk. They offer various policies, overseas investment insurance, reduces risk perception, facilitates access to export finance, gives exporters a competitive edge, and contributes towards export of India growth of India's export and foreign exchange earnings. Moving on with that, we look into the non-banking financial companies. They are the companies that provide financial services similar to banks but do not hold a banking license. What are the key distinctions? They cannot accept demand deposits, cannot issue checks drawn on themselves. Deposit insurance is generally not available to NBFC depositors and are not part of the payment systems or part of the payment and settlement system. Despite limitations, the NBFCs are vital as they fill gaps left by traditional banks, providing quick and flexible credit, specializing in niche sectors and driving financial innovation. Coming on with the next types of NBFC. Asset finance company, financing physical assets like vehicles, machinery, these all happen here. Infrastructure finance company, specializing in large infrastructure loans. Microfinance institution, small loans to low income individuals. Housing finance companies, financing house activities. That's what these types of NBFC does. Now, what are the importance? Like, the importance of NBFC cannot be overstated. Their importance lies in the financial inclusion, reaching underserved segments and geographies, last mile credit delivery, providing quick and flexible delivery, sectoral specialization, expertise in specific sectors, employment generation, indirectly contributing to job creation by financing small businesses, economic growth, critical for capital formation and economic activity as well. Development financial institution, they are specialized financial institutions providing long-term finance for economic development projects, stepping where commercial banks hesitate due to high risk or long gestation periods. They prioritize progress over just profits. Okay, it includes the characteristic long-term funding, providing loans, equity, guarantees for extended periods. Sectoral in focus, specializing in financing specific sectors such as agriculture, industry, infrastructure, etc. Developmental mandate, aiming for development beyond profit. Risk bearing, willing to take on higher risk, often with government backing. Examples in India are National NABARD, which is the Apex Development Bank for agriculture rural development, SIDBI is the principal financial institution for the MSME sector. EXIM Bank, the main institution for financing export and import, and National Housing Bank are the apex institution, financial institution for housing. Development finance institutions are strategic partners in India's growth, tackling challenges commercial banks often avoid. Financial institutions often play several critical roles, such as mobilization of savings, like pooling small savings into a productive investment, capital formation, channeling mobilized savings into investments for economic growth, credit allocation, distributing the credit to various sectors for efficient resource utilization, payment and settlement systems, providing financial infrastructure like NEFT, RTGS, UPI, IMPS, etc. for quick and faster delivery, risk management, offering mechanisms for risk sharing and diversification, example mutual funds, insurance, etc. Financial inclusion, extending services to underserved population. This is something role of financial institution do or does, and they are very important for this economy as well. Financial regulators are the watchdogs that establish guidelines to ensure stability, efficiency, consumer protection, integrity in financial markets. In India, key independent regulators include the Reserve Bank of India, the central bank responsible for monetary policy, banking system regulation and currency management, also can be called as the guardian of the financial stability. SEBI regulates the securities market, protecting investors and promoting the market development. Next comes IRDAI, regulates the insurance sector, issuing licenses, setting capital requirements, and protects the policy holders. Next one is PFRDA, regulates the pension sector, promoting old age income security and overseeing the pension funds and scheme. These regulators continuously adapt to the evolving financial landscape, preventing the financial meltdown. And with that, ladies and gentlemen, we have reached the grand finale. Thank you for embarking on this exhilarating and hopefully not too mind-numbing journey through the world of financial institutions. And I hope you have gained a newfound appreciation for the complex yet crucial roles these entities play in our economy. If you have any question, now is a chance to unleash them. If not, well then, you are either genius or completely overwhelmed. And either way, I applaud you. Thank you for watching. Do watch and subscribe to Learning Through Thalaivar Way channel, where learning is always legendary. Thank you.